If you're investing £20,000 in a UK stocks and shares ISA, it's worth knowing a single percentage point of hidden fees could cost you over 20 years. The truth is, most UK investors are paying it without realizing, as it never shows up as a separate charge. Here's what you need to know: which accounts pay the most, how to switch in under 5 minutes, and the mistake that's costing UK savers thousands every year. It's quite handled once you know. Meet Sarah, 32, from London, earning £42,000 with £25,000 handled in a stocks and shares ISA. Consider this: she's rather unsure about investing in index funds or active funds. It's really important, don't you think, given the UK's current economic situation? They've got different fees. In reality, these can't be ignored as they'll impact her long-term savings, and we're talking significant pound. In the UK, it's around 1.5% for an active fund, while index funds are rather more handled at 0.5%. The data shows, this difference may seem small, but over 20 years, you're looking at £9,000 in hidden fees on a £20,000 investment, which is significantly of pound. What most miss is, for Sarah, who's planning to invest for the long term, this difference could mean an extra £10,000 in retirement savings.
But wait, here is something you probably didn't know. It's quite interesting, really. Here's something you're probably not aware of. Index funds are often the preferred choice over active funds, and it's genuinely straightforward: their fees are lower, don't you think? Active funds have professional managers trying to beat the market, which increases costs. In contrast, index funds just track a market index, like the FTSE 100, without trying to outperform it. The real story is, this lower-cost approach can lead to higher long-term returns for investors like Sarah. For instance, if Sarah invests £10,000 in an index fund, she'll pay £20 in fees per year, whereas an active fund would cost her £80 in fees per year. So, you're covered. Why does this matter right now? And can it save you a pretty pound?
Let's consider Sarah's situation. It's quite straightforward, really. If she invests £25,000 in an active fund, she'll pay £200 in fees per year. The numbers tell a different story. Over 20 years, that's a rather large sum, isn't it? An index fund would cost her £50 in fees per year, or £1,000 over 20 years. Here's the thing: this difference could be a significant portion of her retirement savings, so it's essential for Sarah to consider these fees when making her investment decisions. Straight up, it's handled if she chooses the right fund. But wait, there's more to this story. It's quite interesting, really. Index funds vs active funds, and their performance is rather key. They've had a good run, but most active funds can't consistently outperform their benchmark indices, so even if they've a good year, it won't last. Look at the evidence: index funds are a safer bet, providing broad diversification, and that's handled. For Sarah, looking for stable long-term growth, an index fund might be the way to go. The truth is, many UK investors have seen returns of around 7 to 10% per annum, which is a real decent pound.
This next statistic might genuinely surprise you. It's quite surprising, really. The key to maximizing returns with index funds is to keep costs low and be patient, rather than making rash decisions. The proof is in the numbers. Sarah should invest in a low-cost index fund and hold on to it for the long term. That's the way to go. In reality, she can't afford to make frequent changes to her portfolio, as that'll increase costs and reduce returns, which won't do her any good. By adopting a buy and hold strategy, Sarah can minimize her fees and give her investments the best chance to grow. That's taken care of. The next number changes the whole picture. It's essential for Sarah to understand that past performance isn't a guarantee of future results. What most miss is, choosing a low-cost index fund and taking a long-term approach can increase her chances. Quite handled, really. She can't go wrong. Consider this: around 63% of UK investors have benefited.
It's quite simple, really. Index funds offer the potential for higher returns, and they are rather straightforward. You're gaining exposure to a wide range of assets, don't have to select individual stocks or bonds, which is handled. The data shows, this makes it easier to manage your portfolio and reduces the risk of making costly mistakes. As a British investor, you should know about the different types of index funds, like those tracking the FTSE 100 or the S&P 500. Here's the thing, if you're finding this useful, hitting the subscribe button costs nothing, it's free, and it helps us make more personal finance and investing content for Europeans, so we're rather keen on that. Every pound helps, but in this case, it's free. And here's what most people miss.
Here is the truth that mainstream experts rarely share. The numbers tell a different story. When investing, it's quite straightforward really. You're looking at keeping costs low and being rather patient. The real story is, Sarah's got a better chance of sorting her financial goals if she picks a low-cost index fund and takes a long-term approach, don't you think? It's essential she stays clued up on the UK's economic situation, and here's the thing, reports show many UK investors have seen returns of around 5 to 7% by staying informed and adapting to changing market conditions, so it's worth her while.
So, Sarah's got to research index funds, compare their fees and performance. It's quite straightforward really. Here's the thing, she can use online resources, like comparison websites or financial forums, to find the best option for her needs. She's got to consider what's best for her individual circumstances, don't you think? As a British investor, she's got a few options, like ISAs or SIPP, and you're in good shape once she's got the right investment strategy, which could save her a pretty pound. We're talking 10, 20 years down the line. Straight up, it's worth getting it right. I'll link Wise below. It's what I recommend for Europeans exploring this space. But wait, there's more to this story. So, Sarah's picked an index fund, and now she's all handled. It's just a case of investing her pound and letting time do its thing. The truth is, it's genuinely crucial to remember that investing's a long-term game. Don't make emotional decisions based on short-term market fluctuations. You're better off staying the course, keeping costs low, and you'll increase your chances of achieving your financial goals, rather than making rash decisions. We're talking 5 to 10-year plans here. Reports suggest many UK investors have seen better returns. Look at the evidence. I'll link Wise below. It's what I recommend for Europeans exploring this space.
But there is a catch that almost nobody talks about. There's a catch. In reality, it's quite important. Index funds are a great option for UK investors like Sarah, who want a low-cost way to invest. By choosing a low-cost fund, Sarah can increase her chances of achieving her goals, rather than trying to time the market. The proof is in the numbers. It's essential to stay informed about the UK's economy, so she's handled and can make informed decisions, which is rather crucial for her financial future.
You're probably making a rookie mistake if you're not considering fees when investing in index funds. It's quite a big deal. Consider this, even small differences can add up over time, so you can't go wrong with a low-cost one. It's actually handled. Sarah needs to think about her circumstances. What most miss is, with reports suggesting UK investors have seen better returns with low-cost funds and a long-term approach, it's worth every pound. So, it's time for Sarah to remember that investing in the stock market comes with a bit of risk, to be direct. Here's the thing, by picking a low-cost index fund and taking a long-term view, she's rather more likely to hit her financial targets. The data shows, staying on top of the UK's economic situation is key, as it can impact her investments. As a Brit, Sarah's got a few pounds to invest, and she should be aware of the different types of accounts available. You're covered if she seeks pro advice. In 2026, it's more important than ever for UK investors to be in the know and adapt to changing market conditions, don't you think?
This next figure will likely surprise you. It's time to get handled. The real story is, the next figure will likely surprise you. If you're thinking about investing in index funds or active funds, consider your circumstances and potential risks. You're rather lucky, we're covering it. Watch UK Investing 2026, a beginner's guide to learn more. Don't miss out, take the first step towards securing your financial future, and you won't lose a pretty pound. That's the full picture on our Brits losing pound 1000s to active funds, 2026. The numbers tell a different story. One reader switched to a low-cost index fund last month and saved £200 per year. It took just 10 minutes, quite handled really. Straight up, watching our next video, UK Investing 2026, a beginner's guide, will get you handled. We're talking informed decisions. It's properly straightforward. Subscribe to Eurovolt Finance for weekly personal finance and investing for Europe insights built for UK and European viewers.